The market has been wild, and if you haven't been paying attention, it's all about what Jerome Powell has been talking about over the last 2 days. Now, if you've been keeping up with the weekly reports, I've been talking about how this inflation data is continuing to be sticky, and so heading into these testimonies that Jerome Powell had both yesterday and today, I was expecting him to be hawkish, and I positioned really well. Actually, this week has been an absolute killer week, almost 100% accuracy this week. UNG's been a bit rough, but we'll talk about that in a few moments. But it's been like an exceptional week, but not so much for the market. Now, it isn't as weak as I would have expected though, which could mean two things. Could mean the market's going to go ahead and climb over the fears that Jerome Powell has presented to it, or that we have just pulled the pin on a grenade that's going to cause a lot more bleeding in this market. So first, I just want to give some highlights of what Powell said, what's been happening over the last 2 days, and then we'll go ahead and take a look at the charts and see what they're telling us about how the market feels. And make sure you stay until the end of this video because we're going to talk about what the next big mover for the market will be this week. And in case you're wondering what I'm sitting on right now, this is a tortilla blanket. And yes, it's actually shaped like a tortilla. My girlfriend got it, and I love it. So today was more of a repeat of what was said yesterday when it comes to Powell, although he was a bit more dovish today. We'll talk about that in just a moment. What we want to focus on is what happened yesterday that caused all that bleeding in the market. Powell was very aggressive and said inflation has continued to be sticky, and we will continue to fight it, and that will likely lead to us hiking for higher, longer, and keeping them up. And then we talked about this in the last report, but don't forget that this is a very dramatic change from the last hike that we had, where lots of people are saying, oh, this will probably be the last one. Now we can pause. Inflation's coming down. Everything's going to be honky-dory. That has not been the case. We've seen that the rate expectations have continued to climb as well. And over the last day, we've actually doubled the expectations for a 50 basis point hike rather than a 25 basis point hike on the next. And what's even more troubling for the market is this led to the deepest bond inversion since Volcker suggested a hard landing. Now, it's important to remember who Volcker is because he's the Fed chair that intentionally crashed the market to combat inflation. And it seems like the bond market is telling us that we are very likely to see another recession intentionally caused by the Fed in order to prevent inflation from getting carried away. Now, the market wasn't as bad today, though, because I think Powell said one key thing to keep the market from melting like it did yesterday. And that was, if the economic data allows, they will continue to raise interest rates. If the economic data allows. That is a big change from what he said yesterday, where it sounded like he was going to cause a recession intentionally to keep the markets from coming down. Now, we've already seen the inversion. We've already seen the ways the market is reacting. It seems like bonds are telling us that it is pretty much 80% probability that what I've been saying for, lots of reports now, for a few months now, is likely to happen, where later this year, we will likely see a recession that is intentionally caused by the Fed, and we'll likely see that the Fed will have to do emergency push to save the market. That video that got over 1,000 views, where I was talking about this, saying that trend that usually comes around when we're hiking, market crashes, and the Fed pivots, they try to save the market, they ease rapidly, and then we get a V-shaped recovery. That is very likely to play itself out again, either later this year or early next year. And remember, timing here is going to be so essential. If you're trying to make a macro play like this, remember that the macro moves so slowly. And we've pretty much seen the market just chop since December in the same 380 to 420 range. In fact, it's become tighter and tighter and tighter as well. And so now let's just step back and look at the macro right now. We could see that TLT has been pretty stagnant. We did see that dip down to 98 that I was calling for a few weeks ago. I said, look for that touch. We didn't see that playing out, but then we've seen a big, good, decent bounce there. It's been holding up pretty well. We can also see the movement as soon as Powell made that comment about the if. That was very big because the market doesn't think the economic data will allow them to continue to hike if it's what they actually follow. And if you've been following just what the Fed says, taking them at their word, it's been actually pretty accurate, although they haven't always been right. On the SPY, we could see that we had this sell-off, but we didn't even break 397. There was no real big drawdown. Now, this is a move. We got over 400. It gave that up, and it's been a little bit stagnant today. It's trying to process this information. I don't think that the market was really decided how it feels. And then we saw this huge run-up into the close. Now, this could be two things. This could be retail FOMOing in, once again, saying, oh, we'll just buy the dip. And this could lead to a huge fake out. Or it could be shorts covering, saying, I guess that's all we're going to get for now. And they're trying to get out before tomorrow, which could be a big rally day. Now, I think Friday is going to be the big day to be watching. I think we could see some more stagnation tomorrow. But if we also look at DXY, we can see that the US value of the US dollar has continued to climb. And this could also be causing some pressure on the market, keeping the price suppressed, because DXY is saying, okay, the value of the dollar is going to keep climbing as we continue to raise interest rates. And by the way, the rest of the world is still easing. We're still in that environment where the milkshake theory could spring back to life. So keep it in mind. But here's another thing, and this is really important. VIX is still not even above 20. It barely touched it today, and this was before Powell even spoke. It started to get nervous. Then he caused some calm relaxation to come back to the markets. Now, there's a few things here. It means that the fear in the market still isn't really that high, but it also means that if you want to hedge right now, you want to buy some long dated puts, they're still relatively cheap. Buying is best for options when volatility is low. When volatility is high, it's usually better to be on the sell side, because then you can collect all that premium, because volatility is resolved through clarification. The uncertainty causes a spike in volatility, and then soon when there's some sort of consensus, the market can react. The reaction is done, and now you have some certainty that uses volatility to come down, which is usually great for sellers, because then no matter what happens, you can expect premiums to come down some. If we look at the SPY chart right now, the first thing I want to point out is this head and shoulders that's obviously developing right here. That's the most obvious thing that I can see right now. These usually have a very high probability for playing out. This would mean a further sell-off to the downside if we can actually break this neckline that we're seeing here. Now, the other thing I want to point out is this one potential Elliott wave. Now, I don't think this is the highest probability, but I think it's worth mentioning, since we see this whole head and shoulders development, that this could be a potential wave one. We had a retracement for wave two that actually fits with the Fibonacci measurements. We can see it's about a 50% retracement. Okay, that's okay. That's not too aggressive. That still could technically fit. And then we might see this potential wave three to the downside. Now, I don't think this is the most likely though, because usually what you would see this develop as, or what it most likely probably is an ABC, where we have the A wave, B wave, C wave, and then we're seeing a development of the first wave right now. Now, I'm saying this because Elliott waves usually occur in 8 wave patterns. That's usually a 1, 2, 3, 4, 5, followed by an A, B, C. This is a very clear 1, 2, 3, 4, 5 that I can spot on this chart, which makes me think that this is most likely an ABC, and this is a wave 1. Now, this could be a very short wave 1, which means we're probably likely to see a very short wave 5 as well, because remember, wave 5 and 1 tend to mimic each other. And so we could see this turn into a wave 2, retracement to the downside. Maybe we're already seeing that start to develop. We do see that on the daily TTM squeeze, though, that we are starting to fire to the upside. Remember, when this gets dark, it means there's some bullish momentum coming in the market. However, we've seen cases where this starts to turn back over to the downside. It's just really hard to tell right now. And we can even see, if I scroll in here and get a deeper look at that, you could see that it's been bouncing back and forth a bit, and that Fed meeting, or testimony rather, did have an impact on the market. Now, if we look at something like Tesla, this looks way more obvious to me. I've been sharing this chart a lot. This has been our biggest winner. This was my largest position heading into this week, was coming in short on Tesla. It's done very well. We can see that, we've had about a $30 move down to 180. I'm looking for a break of 180, maybe a potential bounce, and tomorrow we can see that this is turning over in the short term on the 30. I think we're going to see the same thing on the 1 hour. Yeah, that's what I was noticing today. I'm looking for a break of 180 before I come back into this play, because if we look at the daily chart here, we can see that we got a large fifth wave down that we're probably going to be making here. My big targets for this are going to be the 120, 100, and then actually what I have as the deepest low is around $88. Now, let me just say this real quick, because I know there's a lot of Elon fanboys that are not going to like that. Let me be clear that I love Elon. I think he's great. I love Tesla. I think they're great. I mean, I have an Elon poster behind me in every video. Clearly, I don't hate Elon. That's not why I want to short the stock. I simply see what I see, and that's the only reason I'm short. If I see a potential to make money, I'm going to take it. And to finish out the weekly report, I think we should talk about energy. Now, if you watch the report all the way through, there's a lot of other things that we're paying attention to that are being mentioned in the Discord. And I also made a ton of changes in the Discord that I think users are really enjoying. We've actually seen activity pick up in the Discord a ton. That makes me so happy, because it makes me feel like I'm on the right path. I'm making the correct changes to make sure that people are getting the most out of the Discord. So when it comes to UNG, though, I'm still hoping that we get this bounce up. Now, I'm hoping to see a break of $9, and then I'll get back on my options. I had to cut some of those as a loss. Right now, we can see that on the daily, we're still getting the TTM squeeze to the upside right here. All right. And we're seeing some consolidation. We had that shock factor where this decided to touch $10 and then immediately melt down $2. That was really aggressive. But yesterday, or today rather, we saw lots of consolidation. We're seeing the TTM squeeze start to pick up to the upside. I'm not giving up on this play yet. I'm still looking for this fourth wave bounce, still holding my shares. I did cut those options, but I'll be definitely looking to chase this from a $9 break, hopefully up to $12. Now, maybe we go all the way to 13. Maybe we do hit this magic 12.47. I'm not positive. I will, however, be getting out of this fairly early, because as I have charted here, I do have another fifth wave to the downside, and we've seen tons of weakness in energy, and I don't think that was helped at all by what we heard Powell come out and talk about today. He said that he wants to keep tightening, and I don't think that China reopening is going to really help UNG all that much. Now, for USO, this is a bit of a different story, because even though we're seeing lots of weakness when it comes to natural gas, we're seeing a lot of consolidation in USO, and it's holding up pretty well. If you're wanting to short this because you think the recession is going to kill it, that's not been the case so far. And it seems like although technology and good weather was able to solve or at least help UNG, I mean, for those who want the prices to be low so that their expenses aren't stupid high, we've seen that play out. Now, it hasn't been good for me because I wanted to go long it, but I mean, for, you know, the average consumer, this has been great. We're not seeing the same thing in USO, though. And actually, if you look at coal commodities, they're still 3 times higher than they were pre-COVID, and that hasn't been resolved whatsoever. So I think that there could be some potential for USO. This might need to be given some more time, but I'm also going to be keeping a very close eye on this as well. And I almost forgot to talk about it, but we do also need to talk about what's happening Friday, because I think that's the last big mover for the week, and that's going to be the unemployment rate, which comes out on Friday. Now, remember, this comes out before the market opens. Big number here is going to be really bad. That's going to be it for this weekly report, though. I hope you found this helpful, and I will see you on the next one.